Hello there, and welcome. I'm so glad you found your way here tonight. Before we begin, take a moment to get comfortable. Adjust your pillow, let your body settle into whatever position feels right. There's no rush. We have all the time in the world. Where in the world are you watching from? A quiet bedroom as the evening deepens? A cozy corner where the weight of the day is finally lifting? Wherever you are, you're exactly where you need to be. Tonight we're going to explore a story that spans centuries. The story of the London Stock Exchange, born not in marble halls or grand buildings, but in the smoky, bustling coffee houses of 17th century London. We'll discover how merchants and ship captains gathered over coffee and chocolate to trade shares in ventures that sailed to the edges of the known world. We'll walk the narrow lanes of the City of London, meet the men who built fortunes quietly, and understand how this peculiar English institution became the beating heart of global finance. We'll see how something as informal as coffeehouse conversations transformed into one of the world's most powerful financial institutions, shaping empires, funding wars, and creating wealth that echoed across generations. But don't worry, this isn't going to be a frantic recounting of financial chaos or a dry recitation of dates and regulations. Instead, we'll move slowly and carefully through the centuries, through the coffeehouses and counting houses, through crashes and recoveries, through quiet accumulation and spectacular loss. We'll take our time with the stories, the characters, the peculiar customs and unexpected turns. By the end, I think you'll find that the London Stock Exchange was not just about money changing hands, but about human ambition, innovation, and the slow, patient building of systems that changed the world. If you enjoy these calm explorations of financial history, a like and subscribe really helps reach others seeking the same peaceful way to end their day. And to those already subscribed, thank you for being part of this community of thoughtful listeners. So settle in. Let your shoulders drop away from your ears. Take a slow breath, in through your nose, out through your mouth, and let's begin our slow drift through the coffee houses of London, through the birth of modern finance, through centuries of quiet fortunes built and lost and rebuilt again. There's nowhere you need to be. No deadlines to meet. Just listen and let the story unfold like a long, quiet conversation between old friends. Let it wash over you. If you drift away, that's perfectly fine. That's what we're here for. Let's begin in 1666 when London burned. The Great Fire of London started on September 2nd, 1666, in a bakery on Pudding Lane. It burned for 4 days, consuming 13,000 houses, 87 churches, and most of the medieval City of London, the ancient square mile of narrow streets and timber buildings that had stood since Roman times. The fire was catastrophic, yet it also created opportunity. London would be rebuilt, and in that rebuilding the physical and financial landscape of the city would be transformed. Before the fire, London was already England's commercial heart, a port city where ships arrived from every corner of the known world. The Thames was crowded with vessels bringing spices from the East Indies, sugar from the Caribbean, tobacco from Virginia, wool from the English countryside. Merchants grew wealthy on trade, but their business was conducted informally, in taverns, in private homes, on the streets, wherever buyers and sellers happened to meet. Coffee arrived in London in the 1650s, brought by traders who had encountered it in the Ottoman Empire. The first coffee house opened in 1652, and within decades hundreds of coffee houses dotted the city. These weren't like modern coffee shops. They were bustling, smoky rooms where men, and they were almost exclusively men, gathered to talk, to read newspapers, to conduct business. For the price of a penny, anyone could enter, buy a cup of coffee, and participate in conversations that ranged from politics to philosophy to commerce. Different coffee houses attracted different clienteles. Lloyd's Coffee House, opened in 1686 on Tower Street, became the gathering place for ship captains, merchants, and those interested in maritime insurance. Jonathan's Coffee House, established around 1680 on Change Alley, attracted men interested in buying and selling shares in joint stock companies. And it was at Jonathan's, in that narrow alley in the heart of the city, that something remarkable began to take shape. To understand what happened at Jonathan's, we need to understand joint stock companies. These were a relatively new invention, a way of pooling capital for ventures that were too expensive or too risky for any individual to undertake alone. The East India Company, chartered in 1600, was the most famous example. Merchants would invest money, buy shares, in the company, which would use that capital to outfit ships, hire crews, and send expeditions to Asia to trade for spices, silk, and other valuable goods. When the ships returned and the cargo was sold, profits would be distributed to shareholders. Initially, each voyage was treated as a separate venture. You'd invest in a particular expedition, and when it returned, if it returned, you'd receive your share of the profits. But this was cumbersome and risky. Ships were lost to storms, to pirates, to disease. A single disaster could wipe out your entire investment. Over time, the East India Company and others moved to a different model, permanent capital. Instead of investing in individual voyages, you bought shares in the company itself, which operated continuously. You could hold those shares indefinitely, receiving dividends when the company was profitable, or you could sell your shares to someone else. And that's where the secondary market, the buying and selling of existing shares, began to emerge. If you owned shares in the East India Company but needed cash, you could sell them to someone else. But where would you find a buyer? How would you know what price to ask? This is where the coffee houses came in. At Jonathan's, men gathered specifically to trade shares. They'd announce what they wanted to buy or sell, negotiate prices, strike deals. It was informal, chaotic, often raucous, but it worked. The transactions were recorded in handwritten ledgers. Shares changed hands based on verbal agreements, sealed with a handshake or the scratch of a pen. There were no regulations, no official oversight, no standardized procedures. Trust was everything. You had to know the men you were dealing with, had to believe they would honor their commitments. Reputation mattered more than written contracts because there was no authority to enforce contracts in this informal market. By the early 1700s, this informal trading had become substantial enough that it began to attract attention. Some of it was negative attention. In 1711, the writer Joseph Addison published an essay in The Spectator, describing the coffeehouse traders as the greatest pecuniary criminals that were ever hanged in that country. He was exaggerating for effect, but he captured a real concern. These traders were making money not by producing anything tangible, not by growing crops or manufacturing goods, but by buying and selling pieces of paper that represented ownership in distant ventures. To many, this seemed like gambling, not legitimate commerce. There was also a class dimension to the criticism. The traditional aristocracy derived wealth from land, from estates they had owned for generations. The new financial class derived wealth from trade and investment, from cleverness and connections rather than inherited titles. This felt threatening to the established order. It suggested that money, not birth, might determine one's place in society. This tension between old money and new money, between land and finance, would persist for centuries. But despite the criticism, the market kept growing. More companies sought to raise capital by selling shares. More people wanted to invest, hoping to profit from the expansion of trade and empire. By the 1720s, the scene at Jonathan's coffeehouse was frantic. Men crowded into the small space shouting buy and sell orders, negotiating deals, sharing information about which companies were thriving and which were struggling. The noise was deafening, the air thick with tobacco smoke and the smell of coffee, the tables littered with newspapers and handwritten price lists. Then came the South Sea Bubble, and everything changed. In 1720, the South Sea Company, a joint stock company with a monopoly on trade with South America, proposed to assume a large portion of Britain's national debt. The details were complex, involving debt for equity swaps and government payments, but the essential promise was this: invest in the South Sea Company, and you'll profit from trade with the riches of South America, while also helping the nation manage its debts. It was financial innovation mixed with patriotism, and it was extraordinarily compelling. The South Sea Company's share price began to rise. In January 1720, shares traded at around £128. By May, they had reached £500. By June, they briefly touched £1,000, nearly an eightfold increase in 6 months. This wasn't based on actual profits from South American trade, which remained minimal. It was based on speculation, on the belief that the price would keep rising, that getting in now meant getting rich later. Other companies rushed to issue shares, trying to capitalize on the frenzy. Some were legitimate ventures, others were absurd. There's a famous example of a company formed __quote _1__. This company raised £2,000 in a single day before its promoter disappeared, never to be seen again. The enthusiasm for speculation had reached the point where people would invest in literally anything. At Jonathan's Coffee House, the scene was pandemonium. Shares changed hands multiple times in a single day. Fortunes were made in hours. Servants, clerks, anyone with access to even a small amount of capital tried to get in on the boom. The coffee house couldn't contain the crowds. Trading spilled out into Exchange Alley, men shouting prices and waving papers, the narrow lane choked with bodies. And then, as suddenly as it had risen, the bubble burst. By September 1720, doubts were emerging about whether the South Sea Company could actually deliver on its promises. Some insiders began selling their shares, quietly taking profits. The selling spread. The price began to fall, slowly at first, then faster. By December, South Sea Company shares had collapsed back to around £120, wiping out most of the gains. Thousands of people lost their entire investments. Some were ruined completely. The financial and psychological damage was immense. The South Sea Bubble was Britain's first major financial crisis, and it led to the first attempts at regulation. In 1721, Parliament passed the Bubble Act, which required companies to obtain a royal charter or an Act of Parliament before issuing shares. The intent was to prevent fraudulent schemes, to ensure that only legitimate companies could raise capital from the public. The effect was to slow the formation of new joint stock companies for decades, concentrating financial activity among the established firms that already had charters. The stockbrokers who traded at Jonathan's Coffee House also began to organise themselves. They had developed a bad reputation during the bubble, seen as profiteers who had encouraged speculation and profited from others' losses. To rehabilitate their image and to create some order in their market, they began to establish rules. They agreed on standardised procedures for transferring shares, on times when trading would occur, on codes of conduct among themselves. This was self-regulation, driven by the recognition that their livelihoods depended on maintaining at least some degree of trust and legitimacy. In 1748, a group of brokers formed a club, renting a room at Jonathan's Coffee House for their exclusive use. They charged an annual subscription, 6p per year, which gave members access to this private trading room. This was the beginning of the stock exchange as a membership organisation, though it wouldn't formally take that name for several more decades. The idea was simple. By making the market more exclusive, by limiting participation to those who agreed to certain standards of behaviour, they could create a more orderly and trustworthy trading environment. Let that image settle for a moment. Picture that room in Jonathan's Coffee House in the mid-1700s. The smell of coffee and tobacco, the sound of voices arguing over prices, the scratch of pens recording transactions, men in wigs and long coats, some wealthy merchants, some younger men just starting their careers, all gathered in this small space to buy and sell shares in ventures that spanned the globe. This was the humble beginning of an institution that would grow to have enormous power and influence. But in 1748 it was just a room in a coffee house, where men gathered over coffee to trade pieces of paper that represented ownership in distant ships and foreign territories. It was informal, slightly disreputable, but also innovative and essential to the growing British economy. Let yourself imagine being there, the warmth of the coffee, the buzz of conversation, the sense of possibility mixed with risk, and know that we'll continue exploring this story, slowly, together, for as long as you'd like to listen. The 19th century brought transformation to Britain on a scale that was difficult to comprehend while it was happening. The Industrial Revolution, which had begun in the late 1700s with textile mills and steam engines, accelerated dramatically. Factories sprouted across the Midlands and the North. Canals were dug to transport goods more efficiently, and then came the railways, which would change everything. The landscape, the economy, daily life, and crucially for our story, the stock exchange itself. The first public railway, the Stockton and Darlington, opened in 1825. It was primarily for hauling coal, but it demonstrated that steam locomotives could work. Then in 1830 the Liverpool and Manchester Railway opened. The first designed to carry passengers as well as freight. The success was immediate and dramatic. People who had never travelled more than a few miles from their birthplaces could now journey across the country in hours instead of days. Goods could be transported faster and cheaper than ever before. The economic potential was staggering, and investors rushed to participate. Railway companies needed enormous amounts of capital. Building a railway wasn't like starting a shop or even a factory. You needed to purchase land, often through lengthy legal processes involving Parliament. You needed to employ armies of labourers to dig cuttings, build embankments, construct bridges and tunnels. You needed to purchase locomotives and rolling stock, to build stations, to hire staff. The cost ran into hundreds of thousands or even millions of pounds, far more than any individual or small group of investors could provide. The solution was the joint stock company, and this meant shares, and shares meant the stock exchange. In the 1830s and 1840s, railway shares became the dominant securities traded on the London Stock Exchange. Every week brought news of new railway schemes, new routes proposed, new companies seeking to raise capital. Some were legitimate, backed by serious engineers and businessmen with realistic plans. Others were speculative ventures, promoted by opportunists who hoped to profit from the public enthusiasm for railways without necessarily ever building a functional line. The stock exchange became the arena where these companies sought capital, and where investors tried to distinguish the promising ventures from the fraudulent ones. The process of raising capital for a railway typically began with a prospectus, a document describing the proposed route, estimating costs and revenues, listing the directors and prominent supporters. This prospectus would be circulated to potential investors. If enough interest materialized, shares would be offered for sale. Often you didn't have to pay the full price up front. Instead, you'd make an initial deposit and then pay the remainder in installments, as the railway company called for capital. This made it easier for people of moderate means to invest, but it also created obligations. If you subscribed for shares and the company later called for additional payments, you were legally bound to provide them, even if your circumstances had changed or you'd changed your mind about the investment. The railways attracted investors from across the social spectrum. Wealthy landowners invested, sometimes because a railway crossing their land would increase its value, sometimes simply to profit from the railway boom. Middle-class professionals, lawyers, doctors, merchants, invested their savings, hoping to secure comfortable retirements or to leave inheritances to their children. Even working people with small amounts of capital saved from wages tried to get in on the opportunities. Clergy invested church funds. Women, who had few economic opportunities of their own, invested inheritances or dowries. The railways democratized investment in a way that nothing before had quite achieved. This democratization wasn't entirely positive. Many of these new investors had no experience with financial markets, no ability to evaluate the claims made in railway prospectuses, no understanding of the risks involved. They relied on the reputations of the directors, on reassurances from promoters, on the general enthusiasm for railways. They assumed, often incorrectly, that any railway investment would be profitable. The stock exchange brokers who sold them shares were motivated by commissions, not necessarily by the investors' best interests. The potential for ordinary people to be misled, to lose savings they could ill afford to lose, was substantial. By the mid-1840s, railway speculation had reached fever pitch. This period became known as railway mania, comparable in some ways to the South Sea bubble of the previous century. In 1845 alone, Parliament received applications for over 600 railway schemes, representing thousands of miles of proposed track and requiring capital that exceeded the entire gross domestic product of Britain. This was clearly unsustainable. Not all these railways could possibly be built, and even if they were, many wouldn't generate the revenues their prospectuses promised. But in the grip of mania, people suspended disbelief. The prevailing sentiment was that railways were the future, that getting in early would guarantee wealth, that missing out was the only real risk. The stock exchange during railway mania was a scene of extraordinary activity. The trading floor was packed with brokers buying and selling railway shares. Prices fluctuated wildly based on rumours, on parliamentary decisions about which schemes would be approved, on competition between rival lines. Fortunes were made in days. Speculators would buy shares in a newly promoted company, then sell them at a profit before any actual construction began, before anyone knew whether the railway would ever be built. This wasn't investment in the traditional sense, providing capital for productive enterprise. This was pure speculation, betting on price movements, hoping to profit from the enthusiasm of the next buyer. The boom couldn't last, and it didn't. By 1847, the inevitable reckoning arrived. Many railway companies had promised more than they could deliver. Construction costs exceeded estimates. Competition between lines reduced revenues below projections. Some companies had been fraudulent from the start, existing only to enrich their promoters. As these realities became apparent, share prices began to fall. Investors who had bought at peak prices faced losses. Those who had subscribed for shares and made initial deposits found themselves obligated to make additional payments to companies whose shares were now worth less than they'd paid. Some investors were ruined, unable to meet the calls for capital, forced to default and lose everything they'd invested. The human cost of railway mania's collapse was significant. Middle-class families who had invested savings accumulated over decades saw those savings disappear. Widows who had put inheritance money into railway shares found themselves impoverished. Clergy who had invested church funds faced scandal and disgrace. Working people who had scraped together small amounts to invest lost what little financial security they had. The psychological impact was also substantial. The shame of having been foolish, the anger at having been misled, the fear of an uncertain future. These weren't abstract losses shown in ledgers. They were personal disasters that affected real people's lives. Yet despite the crash, the railways themselves survived, and indeed thrived. Many of the lines that had been built during the mania continued to operate, consolidating into larger companies, becoming essential infrastructure. By the middle of the 19th century, Britain had developed a comprehensive railway network that was the envy of the world. The speculation had been excessive, the losses painful, but the ultimate result was transformative. The railways made Britain smaller, connected communities that had been isolated, enabled industrial growth that wouldn't have been possible with canals and roads alone. The investors who lost money had, inadvertently, financed a revolution in transportation that benefited the entire nation, even if they personally saw no return. The stock exchange emerged from railway mania larger and more important than before. The volume of securities being traded had expanded enormously. The membership had grown. New practices had developed to handle the increased complexity. The exchange had proven it could manage massive capital flows, could facilitate the funding of enormous projects, could adapt to new kinds of securities and new patterns of speculation. But the mania had also revealed weaknesses, the susceptibility to bubbles, the difficulty of protecting unsophisticated investors, the potential for manipulation and fraud. In response to railway mania and its aftermath, there were calls for reform. Some argued the stock exchange should be more heavily regulated, that the government should oversee it to protect the public. Others argued that investors needed to take responsibility for their own decisions, that regulation would stifle the market's dynamism. The stock exchange itself resisted external regulation, preferring to maintain its status as a self-regulating private club. It did, however, implement some internal reforms, tightening its membership requirements, improving its procedures for settling transactions, attempting to maintain orderly markets even during periods of speculation. Parliament also responded, though cautiously. The Joint Stock Companies Act of 1844 required companies to register and to provide basic information about their finances. The Limited Liability Act of 1855 allowed shareholders to limit their potential losses to the amount they had invested, rather than being liable for the company's entire debts. This was a crucial change. Before limited liability, investing in a company meant you could potentially lose not just your investment, but everything you owned if the company failed and couldn't pay its creditors. This risk had deterred many potential investors. Limited liability made investing safer, encouraging broader participation in the stock market. These legal changes, combined with the infrastructure created during railway mania, set the stage for the stock exchange's continued growth through the second half of the 19th century. New industries emerged, mining companies exploiting resources in Africa and Australia, telegraph companies connecting continents, gas and water companies serving Britain's growing cities. Each of these industries needed capital, and they raised it by selling shares on the stock exchange. The range of available investments expanded far beyond the handful of chartered companies and government bonds that had dominated the market in the previous century. The physical stock exchange building also evolved. In 1854, the exchange moved to a larger building, still on Threadneedle Street, but with more space for the growing number of members and the increasing volume of trading. The new building had an expanded trading floor, better facilities for settling transactions, offices for the growing administrative staff needed to manage the organisation. It was an impressive structure, reflecting the stock exchange's status as a central institution of British finance. The membership of the stock exchange became more formalised and stratified. There were now clear distinctions between jobbers and brokers, two different roles in the trading process. Brokers acted as agents for clients, buying and selling on their behalf in exchange for commissions. Jobbers, also called dealers, acted as principals, maintaining inventories of securities and buying and selling from their own accounts. When a broker had a client who wanted to buy shares, the broker would go to a jobber who dealt in those particular shares. The jobber would quote a price, actually two prices, a bid price at which the jobber would buy and an asked price at which the jobber would sell. The spread between these two prices was the jobber's profit. This system, known as single capacity, meant that each member of the exchange performed only one role. You were either a broker or a jobber, not both. This was meant to prevent conflicts of interest, to ensure that brokers acted in their clients' interests rather than in their own. The culture of the stock exchange in the Victorian era was distinctly masculine and hierarchical. It was a world of formal dress codes, of understood but unwritten rules, of carefully maintained social distinctions. Senior members, successful brokers and jobbers who had made fortunes, commanded respect and deference. Younger men, clerks and assistants learning the business, knew their place and waited their turn. There was a strong emphasis on honour and trust. Your word was your bond, and a handshake sealed a deal as surely as a written contract. This culture served a function. In a market based on deferred settlement and credit relationships, personal reputation was essential. You had to trust that the people you dealt with would honour their obligations, but this culture also served to exclude. The stock exchange was an overwhelmingly Protestant institution. Jews faced barriers to membership, though some exceptional individuals managed to gain entry and even achieve prominence. Catholics were also underrepresented. Women were entirely excluded from membership, unable to trade on the floor regardless of their wealth or knowledge. The stock exchange reflected the broader prejudices and hierarchies of Victorian society, even as it played a role in reshaping that society through its economic influence. Through the middle decades of the 19th century, as Britain's empire expanded and its industrial economy grew, the London Stock Exchange became increasingly international in its reach. British investors bought shares in companies operating in India, in South Africa, in Australia, in South America. Capital flowed from London to every corner of the globe, financing railways, mines, plantations, infrastructure. The stock exchange was the mechanism through which this capital flowed, the marketplace where British savings were converted into investments in distant enterprises. London was becoming the financial capital of the world, and the stock exchange was at the heart of that role. This internationalisation brought both opportunities and challenges. The opportunities were obvious: access to investments with potentially higher returns than were available domestically, the ability to diversify across different markets and economies, participation in the opening up of new territories and resources. The challenges were also significant. Information about distant companies was even harder to obtain and verify than information about British firms. The legal systems in many countries didn't provide the same protections for investors. Political instability, wars and revolutions in foreign countries could destroy investments overnight. British investors had to navigate these risks, often with limited information and limited recourse if things went wrong. The stock exchange tried to manage some of these risks through its listing requirements. To have shares traded on the exchange, a company had to provide certain information, had to meet certain standards. But these requirements were not rigorous by modern standards, and enforcement was inconsistent. Fraudulent or poorly managed companies could sometimes obtain listings. Investors had to conduct their own due diligence, had to educate themselves about the investments they were making. Those with the knowledge and connections to do this well prospered. Those without often suffered losses. As we moved toward the end of the 19th century, the stock exchange had completed a remarkable journey. From the coffee houses of the 17th century, through the South Sea Bubble and the Napoleonic Wars, Through railway mania and the industrial transformation of Britain, it had grown into one of the world's premier financial institutions. It had facilitated the raising of capital on an unprecedented scale, had enabled the funding of infrastructure and industry, had created mechanisms for spreading risk and enabling investment. But it had also been the site of speculation and scandal, had enabled fortunes to be made through information advantages and market manipulation, had sometimes served the interests of insiders over the interests of the broader public. It was, in short, a human institution, capable of great utility and great abuse, reflecting the ambitions and the flaws of the society that created it. And its story was far from over, as the 20th century would bring new challenges, new opportunities, and new transformations that would test whether the practices and culture developed over 2 centuries could adapt to a changing world. If you're finding these contemplative explorations of Westerosi history and politics a peaceful way to end your day, a like and subscribe really helps others discover these gentle journeys through the past. And to those already subscribed, thank you for being part of this community of those who find comfort in slowly unfolding stories of power and patience, of roses growing strong through centuries of careful cultivation. The final decade of the 19th century and the opening years of the 20th brought a sense of confidence and prosperity to Britain that seemed, at the time, as though it might last forever. This was the Edwardian era, named for King Edward VII, who reigned from 1901 to 1910, though the spirit of the age really began in the late 1890s. Britain's empire was at its zenith, stretching across a quarter of the world's land surface. London was the undisputed financial capital of the globe. The pound sterling was the international currency of choice, and the stock exchange was the institution through which much of the world's capital flowed. The volume of securities traded on the London Stock Exchange had grown exponentially. In 1870, the nominal value of securities listed was around £2 billion. By 1900, it had reached over £4 billion. British investors owned assets in every continent. They financed railways in Argentina and gold mines in South Africa, rubber plantations in Malaya, and cattle ranches in Australia. This wasn't just wealthy aristocrats investing surplus capital. Middle-class savers, doctors and solicitors and merchants invested in foreign securities as a routine part of managing their finances. The stock exchange had become integral to how ordinary prosperous Britons thought about saving and investing. The physical stock exchange building was rebuilt again in 1901, a grand structure befitting its importance. The new building on Threadneedle Street had an impressive trading floor with a high domed ceiling, ornate decorations, and space for hundreds of members to conduct business simultaneously. Visitors' galleries allowed the public to observe trading, though not to participate. The building made a statement. The stock exchange was a pillar of British finance, permanent and prestigious, as solid as the Bank of England that stood nearby. The social world of the stock exchange in the Edwardian period was elaborate and ritualized. Members dressed formally, morning coats, top hats, the costume of respectable Victorian gentlemen. There was a strict hierarchy. Senior members, particularly successful jobbers who had accumulated substantial wealth, occupied positions of authority and prestige. They might serve on the exchange's governing committee, making rules and settling disputes. Below them were the successful brokers with established client relationships and steady commission income. Then came younger members still building their businesses, clerks learning the trade, and at the bottom, the blue button boys, young men who wore distinctive blue buttons and performed errands, carrying messages across the trading floor, fetching documents, performing the routine tasks that kept the market functioning. The workday had a predictable rhythm. Trading officially began at 10 o'clock in the morning and continued until mid-afternoon, though much business was also conducted before and after these hours in nearby offices and restaurants. The trading floor was loud and crowded. Jobbers stood at their designated pitches, specific locations on the floor where they dealt in particular securities. Brokers circulated, approaching jobbers to request quotes. A broker might say simply, "consols," the name for government bonds, and the jobber would respond with 2 prices, 90 1/4 to a half, meaning the jobber would buy at 90 1/4 pounds and sell at 90 1/2 pounds per £100 of face value. The broker would then either accept one of these prices or move to another jobber to see if they could get better terms. Transactions were recorded on cards that brokers and jobbers maintained. with formal settlement occurring on account days that happened every 2 weeks. On account day, all the transactions from the previous fortnight would be settled. Shares transferred, money exchanged, credits and debits balanced. This deferred settlement created opportunities for speculation. You could buy shares expecting to sell them before account day, profiting from price movements without ever actually paying for or taking possession of the shares. This was called trading for the account, and it was common. It created leverage and risk, amplifying both gains and losses, but it was an accepted part of how the market functioned. The information available to investors was improving, but remained imperfect. Companies were now required to publish annual reports with basic financial information, but the level of detail and the accounting standards varied. There was no requirement for audited statements in many cases. Company directors could, and sometimes did, present optimistic or misleading pictures of their firm's financial health. Investors tried to gather information from multiple sources, reading company reports, consulting with brokers who specialized in particular industries, following news reports, attending shareholder meetings. Those with inside connections, with friendships or family relationships with company directors, had significant advantages. The market was never quite a level playing field. One of the most significant developments in the late Victorian and Edwardian periods was the growth of investment trusts and the emergence of professional fund management. Investment trusts were companies whose sole purpose was to invest in other companies' shares. An individual investor could buy shares in an investment trust and thereby gain diversified exposure to multiple investments without having to select individual stocks. This was particularly useful for smaller investors who didn't have the capital to build diversified portfolios on their own, or the expertise to evaluate individual securities. The concept was innovative and initially quite successful. Investment trusts proliferated in the 1880s and 1890s, offering exposure to foreign markets, to specific industries, to various combinations of securities. They were managed by professionals who, in theory, had superior knowledge and judgment. Investors paid fees for this management, but many felt the fees were worth it for the reduced risk and superior returns they expected. The reality was more mixed. Some investment trusts were well managed and delivered solid returns. Others were poorly managed or engaged in conflicts of interest, enriching their managers while delivering mediocre results to shareholders. But the principle that professional intermediaries could manage investments on behalf of less sophisticated investors became established and would persist. The stock exchange's role in financing the British Empire deserves particular attention. As Britain expanded its control over territories in Africa, Asia, and elsewhere, enormous capital was needed to develop these colonies. Railways had to be built to transport raw materials to ports. Mines had to be sunk to extract gold, diamonds, copper, and other resources. Plantations had to be established to grow rubber, tea, coffee, cotton. All of this required investment, and much of that investment came from British savers channeled through the London Stock Exchange. The expansion into South Africa provides a vivid example. The discovery of gold in the Transvaal in the 1880s created a rush of investment. Mining companies were formed, shares were issued, and British investors poured money into South African gold mining. Some of these investments were enormously profitable. Companies like Consolidated Goldfields and De Beers, built on gold and diamond mining, created vast fortunes for their founders and substantial returns for investors. Cecil Rhodes, the mining magnate and imperialist, used wealth generated through these enterprises to fund territorial expansion, creating Rhodesia and extending British control northward. But South African investments also involved enormous risks and moral complexities. The mining operations depended on exploitative labour systems, with black African workers employed under harsh conditions for minimal wages. The political situation was unstable, with tensions between British colonists, Afrikaner settlers, and indigenous populations. These tensions erupted into the Boer War from 1899 to 1902, a brutal conflict that cost thousands of lives and vast amounts of money. British investors who held South African mining shares watched nervously as the war progressed, knowing that their investment's value depended on the outcome. When Britain ultimately won, securing control over the Transvaal and its gold, share prices recovered and even rose. The financial and human costs of imperialism were linked. though British investors often didn't fully confront the moral implications of profiting from colonial exploitation. The stock exchange was also becoming more international in another sense. It was competing with other stock exchanges, particularly with New York. The New York Stock Exchange, founded in 1792, had grown steadily through the 19th century, but it remained secondary to London for most of that period. By the early 20th century, however, America's rapid industrial growth and the development of major corporations like US Steel, Standard Oil, and General Electric meant that New York was becoming a financial center of global significance. American companies were raising capital, American investors were accumulating wealth, and the New York Stock Exchange was handling increasing volumes of trading. London still led in international finance. If you were an Argentine railway company or an Australian mining company seeking to raise capital, you likely came to London, where British investors had both the money and the appetite for foreign investments. But for American securities, New York was increasingly the primary market. This competition would intensify in the coming decades, particularly after the First World War, but already in the Edwardian period. Perceptive observers could see that London's dominance wasn't necessarily permanent. The daily life of a stockbroker in this period was comfortable if you were successful. You might arrive at your office in the city in mid-morning, review overnight news and correspondence, then walk to the stock exchange for a few hours of trading. Lunch would be taken at one of the nearby chop houses or clubs, where you'd discuss market conditions with colleagues, share information, perhaps conduct business over the meal. The afternoon might involve more trading, meetings with clients, preparation of paperwork. You'd return home to a comfortable house in the suburbs by early evening, served by domestic staff, your wife managing the household, your children being educated at good schools. It was a life of solid middle-class or even upper-middle-class comfort, built on commission income from facilitating other people's investments. This comfortable world rested on assumptions that seemed self-evident at the time but would prove fragile. There was an assumption of stability, that the international system of trade and investment would continue, that the empire would endure, that Britain's financial dominance was secure. There was an assumption of progress, that economic growth would continue, that new technologies and new markets would create endless opportunities. And there was an assumption of order, that the social hierarchies and institutions that governed British life would persist without fundamental challenge. Some people questioned these assumptions. Socialist critics argued that the stock exchange was parasitic, that stockbrokers contributed nothing real to society, that they merely skimmed profits from the productive labour of others. These critics pointed to the extremes of wealth and poverty in Edwardian Britain, to the slums of East London existing just miles from the prosperous city, to the workers who laboured for subsistence wages while investors collected dividends. The stock exchange, in this view, was part of a system that concentrated wealth and power in the hands of a few while the many struggled. The stock exchange and its members had responses to these criticisms. They argued that they performed a useful function, facilitating the flow of capital to productive uses, enabling enterprises that wouldn't otherwise be possible, providing liquidity that allowed investors to buy and sell assets. Without the stock exchange, they claimed, it would be much harder to fund railways, mines, factories, all the infrastructure of a modern economy. The fact that they profited from this service didn't negate its usefulness. This argument had merit, though it didn't fully address the deeper questions about inequality and about whose interests the financial system primarily served. Women's relationship to the stock exchange in this period was complex and contradictory. Women couldn't be members, couldn't trade on the floor, couldn't become brokers or jobbers. The stock exchange was an exclusively male space, part of the broader exclusion of women from many professional and commercial activities. But women could and did own shares. Widows who inherited securities from their husbands, unmarried women who possessed independent wealth, even married women who had settlements or separate property, all could be investors. They had to work through male brokers, had to rely on male advisors, but they could participate in the market as clients, if not as professionals. Some women became quite sophisticated investors, managing substantial portfolios, making their own decisions about what to buy and sell. They read financial newspapers, attended shareholder meetings, wrote to company directors with questions and suggestions. They were active economic agents, even though they were excluded from the formal institutions of finance. This contradiction, women as investors but not as professionals, as clients but not as members, reflected the broader tensions in Edwardian society about women's roles and capabilities. The stock exchange in the early 20th century was also a place of innovation in communication and information technology. The telegraph had revolutionized how quickly information could travel. News of events in South Africa or South America could reach London in hours instead of weeks. The stock exchange installed telegraph and later telephone connections, allowing brokers to communicate with clients and with correspondents abroad more efficiently. Ticker tape machines, which printed out stock prices on narrow strips of paper, were introduced, giving brokers real-time information about price movements. These technologies made the market more efficient but also faster-paced, more reactive to news, potentially more volatile. Through all these developments, the physical expansion, the growing volumes, the technological innovations, the international reach, the fundamental structure of the stock exchange remained remarkably stable. It was still a private members' club, self-regulating, operating according to traditions and customs that had evolved over 2 centuries. The Committee for General Purposes, elected by the membership, made rules and resolved disputes. The distinction between jobbers and brokers persisted. The culture of handshake deals and personal honour endured. There was resistance to external regulation, a belief that the market could and should govern itself. This resistance would be tested by the crisis that was approaching, though few in the comfortable Edwardian summers before 1914 could imagine what was coming. The stock exchange had survived crises before: the South Sea Bubble, the Napoleonic Wars, railway mania. Each time it had adapted and emerged stronger. There was confidence that it would continue to do so, that whatever challenges arose could be managed within the existing framework. This confidence was about to be shaken in ways that no one anticipated, as the world itself was about to change more dramatically than anyone could foresee. But in those final peaceful years of the Edwardian era, as the sun set over the city of London and brokers made their way home from another successful day of trading, the future seemed secure, the system seemed sound, and the stock exchange seemed as permanent as the buildings that housed it. The assassination of Archduke Franz Ferdinand in Sarajevo on June 28, 1914, seemed at first like another in a long series of Balkan crises that periodically troubled European diplomacy, but rarely amounted to much. The stock exchange noted the news but didn't react dramatically. Prices dipped slightly on concerns about instability, but there was no panic. Europe had navigated similar tensions before. Surely diplomacy would prevail, or at worst any conflict would be limited and brief. But this time was different. Through July, as Austria-Hungary issued ultimatums to Serbia, as Russia mobilized in support of Serbia, as Germany supported Austria-Hungary, as France prepared to honour its alliance with Russia, the realization slowly dawned that Europe was sliding toward a general war. The stock exchange began to react with increasing alarm. Prices fell as investors sought to sell securities and move into cash or gold. Foreign investors, particularly those from continental Europe, wanted to liquidate their holdings in London and repatriate their capital. The selling pressure intensified day by day. By the final week of July 1914, the stock exchange was in crisis. The volume of selling was overwhelming the market's capacity to absorb it. Prices were falling rapidly, and there was no clear bottom in sight. More critically, the international payment system was breaking down. Investors who sold securities needed to be paid, often in foreign currencies or in gold. But the banking system, which normally facilitated these payments, was under severe strain. Banks were hesitant to send gold abroad when they might need it to maintain their own solvency. Foreign exchange markets were becoming chaotic as currencies fluctuated wildly against each other. The Committee of the Stock Exchange faced a decision unprecedented in the institution's history. They could keep the exchange open and watch as prices collapsed and the financial system potentially unravelled. Or they could close the exchange, suspending trading entirely until the crisis passed. On the morning of Friday, July 31st, 1914, they made the extraordinary decision to close. For the first time since its founding, the London Stock Exchange would not open for trading. The doors were locked. The trading floor stood empty and silent. This closure was meant to be temporary, a brief pause to allow the situation to stabilise. But the war that began in August 1914 would not be brief. The stock exchange remained closed not for days or weeks, but for months. It didn't fully reopen for normal trading until January 4th, 1915, over 5 months later. Even then, trading was restricted. Dealings in many foreign securities were prohibited. Prices were controlled to prevent panic selling. The free market that had operated for over 2 centuries was suspended, replaced by a managed market operating under government oversight and wartime restrictions. The impact of this closure extended far beyond the trading floor. Investors who owned securities found themselves unable to sell them. The paper value of their holdings became almost meaningless because there was no functioning market where those securities could be converted to cash. People who had counted on being able to liquidate investments if they needed money found themselves locked in. This was particularly difficult for those who faced financial pressures due to the war, businesses disrupted by the mobilization, families who lost breadwinners to military service, anyone whose economic circumstances changed and who needed access to capital. The closure also revealed how central the stock exchange had become to the British financial system. When it stopped functioning, the effects rippled through the entire economy. Banks that had used securities as collateral for loans found that collateral's value uncertain. Insurance companies that held securities as reserves against future claims couldn't easily value those reserves. Trust funds and estates that were supposed to provide income to beneficiaries couldn't easily sell securities to meet obligations. The stock exchange's role had become so integral that its absence created problems throughout the financial structure. When trading resumed in January 1915, it was in a very different context. Britain was at war, engaged in a conflict that was already far bloodier and more destructive than anyone had anticipated. The initial expectation that the war would be over by Christmas had proven tragically wrong. The Western Front had settled into trench warfare, with hundreds of thousands of casualties and no clear path to victory. The government needed to mobilize the entire nation's resources for the war effort, and that included the financial resources managed through the stock exchange. Government borrowing became enormous to finance the war, to pay for armies, munitions, ships, all the vast machinery of modern industrial warfare. The government issued bonds on an unprecedented scale. The national debt, which had been around £650 million in 1914, would grow to over £7 billion by 1919. The stock exchange became the primary mechanism for distributing these bonds, for finding buyers among British investors who were encouraged, even pressured, to lend their savings to the war effort. War bonds were marketed with appeals to patriotism. Posters and advertisements urged citizens to invest in bonds as a way of supporting the troops, of contributing to victory, of doing their duty. The returns offered were modest. 5% was typical, but the appeal wasn't primarily financial. It was moral and national. Lending money to the government was presented as equivalent to fighting, a way for those who couldn't serve in the military to contribute to the national struggle. Women, elderly people, even children with small savings were encouraged to buy war bonds. The stock exchange facilitated this borrowing, but the process was managed much more directly by the government than peacetime borrowing had been. The Treasury worked closely with the Bank of England and with major financial institutions to organise bond issues, to set prices, to ensure that the securities were distributed widely. The stock exchange was part of this system, but it was no longer operating independently according to its own rules and customs. It was functioning as part of a centrally managed wartime economy. Trading in other securities continued under restrictions. Prices were not allowed to fall below certain minimum levels, which meant that natural market forces were suppressed. If investors wanted to sell and no buyers could be found at the minimum price, the transactions simply wouldn't occur. This price control was meant to prevent panic and to maintain confidence, but it also meant that prices didn't necessarily reflect true supply and demand. The market was managed, artificial in important ways. Foreign securities were particularly restricted. Trading in securities from enemy countries, Germany, Austria, Hungary, Turkey, was prohibited entirely. British investors who owned German or Austrian securities found them essentially worthless, at least for the duration of the war. Trading in securities from neutral countries or from allies was sometimes allowed, but often subject to special permissions or restrictions. The government wanted to control capital flows, to prevent money from leaving Britain when it was needed for the war effort, to ensure that financial resources were directed toward winning the war. The human experience of the stock exchange during the war years was marked by absence and loss. Many of the younger members, the clerks and junior brokers, enlisted in the military. They left the trading floor for the trenches, and many never returned. The casualty rates among Britain's educated middle classes were horrific. Grammar school boys and university graduates volunteered or were conscripted as junior officers, and junior officers died in disproportionate numbers, leading their men over the top into machine gun fire and artillery barrages. The stock exchange maintained a roll of honour, listing members who served and died. The names accumulated year after year as the war ground on. Those who remained on the trading floor, older men, those in reserved occupations, those medically unfit for service, carried on, but the atmosphere was subdued. The boisterous confidence of the Edwardian years was gone, replaced by grim determination and anxiety about the war's outcome. Trading was quieter, less frantic. The mechanisms continued to function, but the spirit had changed. There was a sense of going through motions, of maintaining routines while the world outside descended into unprecedented catastrophe. Women entered the financial sector during the war in roles they had previously been excluded from. With so many men away at the front, businesses needed workers, and women filled the gap. They worked as clerks, as typists, as bookkeepers, handling the paperwork and administrative tasks that kept the financial system operating. They couldn't trade on the floor, that remained exclusively male, but they became essential to the back-office operations. This was true across many industries during the war, and it began to shift perceptions about women's capabilities and appropriate roles, though the changes would be partial and contested. The war also accelerated technological and organisational changes that had been developing before 1914. The need to manage vast amounts of information, bond issues, rationing systems, production schedules, casualty lists, drove improvements in record-keeping and communication. The financial sector adopted these improvements. Filing systems became more systematic, communication more standardised, processes more rationalised. The somewhat chaotic personal practices of the Victorian era were giving way to more bureaucratic, systematised approaches. This made the system more efficient but also less personal, less dependent on individual relationships and more dependent on formal procedures. By 1917 and 1918, as the war entered its final terrible years, British society was exhausted. The casualty lists were incomprehensible in their scale. Nearly every family had lost someone. Sons, brothers, fathers, husbands. The economic strain was severe. Rationing restricted consumption. Taxes had risen dramatically to help pay for the war. Living standards for most people had fallen. The pre-war world of comfort and confidence seemed impossibly distant, almost like it had belonged to a different civilization. The stock exchange reflected this exhaustion. Trading volumes were low. There was little enthusiasm for investment, little spare capital to invest even if enthusiasm had existed. People were focused on survival, on getting through each day, on hoping the war would end before it consumed everything. The question of whether Britain would win had been answered. By late 1918, with American entry into the war and German resources nearly depleted, Allied victory was increasingly certain. But the cost of that victory was staggering. Almost too much to comprehend. When the armistice was signed on November 11, 1918, the immediate reaction was relief, even joy. The killing had stopped. Men would come home. But the relief was mixed with grief for those who wouldn't return, with awareness of how much had been destroyed, with uncertainty about what kind of world would emerge from the wreckage. The stock exchange, like all British institutions, had survived the war, but it had changed, and the world it operated in had changed even more dramatically. The international financial system that had existed before 1914 was shattered. The gold standard, which had facilitated international trade and investment, had been suspended. Currencies had been inflated to pay for the war, and their relationships to each other were uncertain. The network of trade and credit that had connected London to financial centres around the world had been disrupted. Britain was no longer the unquestioned financial centre of the world. The war had cost Britain enormous amounts of wealth, through direct expenditure, through destruction of assets, through the sale of foreign investments to pay for war supplies. Britain had gone from being the world's largest creditor nation to being significantly indebted. particularly to the United States. The United States emerged from the war in a much stronger financial position. American industry had supplied the Allies with weapons, food, raw materials. American banks had lent money to Britain and France. The dollar, not the pound, was increasingly the currency that mattered in international transactions. New York was challenging London as a financial centre. This shift would have profound implications for the London Stock Exchange, though the full extent wouldn't be clear for years. Domestically, Britain faced enormous challenges. The men returning from the war needed jobs, housing, support if they'd been wounded or disabled. The industrial economy needed to shift from wartime production back to peacetime production. The government needed to manage a debt burden that was unprecedented in British history. Social tensions were high. Working-class soldiers who had fought and suffered expected something in return. Better housing, better jobs, a voice in how the country was run. The easy assumptions of Edwardian hierarchy were harder to maintain after millions of ordinary men had endured hell in the trenches, while many wealthy men had stayed safely at home. The stock exchange resumed something closer to normal operations in the early 1920s, though normal now meant something different than it had before the war. Trading restrictions were gradually lifted. Foreign securities could be traded more freely. Price controls were removed, allowing market forces to operate again. The membership returned to something like its pre-war size as surviving veterans came back to their positions, and new members were admitted to replace those who had died. But the culture and assumptions had shifted. There was less confidence, less certainty that the system would endure, less faith in automatic progress. The war had demonstrated that civilization was fragile, that catastrophe could arrive suddenly, that institutions and arrangements that seemed permanent could collapse. This awareness created a certain tentativeness, a holding back, even as trading resumed and the mechanisms of finance continued to function. The securities being traded had also changed in character. Before the war, foreign securities, particularly those from the Empire and from South America, had dominated the market. British investors had sent capital around the world. After the war, there was more focus on domestic securities, on British companies operating in Britain. This partly reflected reduced capital available for foreign investment. Britain was poorer, needed to rebuild at home, but it also reflected increased risk perception. Foreign investments had proven vulnerable to war and political upheaval. Better to invest closer to home, where you understood conditions, where the rule of law was reliable. The 1920s would bring new challenges and opportunities for the stock exchange, new securities to trade, new practices to adopt, new competitions to navigate. But the institution that emerged from the First World War was fundamentally different from the institution that had entered it. The war had broken something in British confidence, in the assumption of natural superiority and inevitable prosperity that had characterized the Edwardian period. The stock exchange, like Britain itself, would continue, would adapt, would find new roles and new ways of operating. But the easy certainties of the pre-war world were gone, replaced by awareness of fragility, by memory of catastrophic loss, by knowledge that the future was uncertain and that the institutions we rely on can fail when we need them most. Let that knowledge settle quietly as we continue through the story of how the stock exchange navigated the difficult decades that followed the Great War. The 1920s brought a peculiar mixture of recovery and underlying fragility to Britain and to the stock exchange. On the surface, life was returning to something like normalcy. The soldiers had come home, the economy was shifting back to peacetime production, and the trading floor at the stock exchange was busy again with brokers and jobbers conducting their daily business. But underneath the surface activity, there were structural problems that wouldn't be easily solved, legacies of the war that would shape British economic life for decades. Britain's international financial position had fundamentally weakened. Before the war, Britain had been the world's banker, lending money globally, earning returns from investments scattered across every continent. The war had forced Britain to liquidate many of these foreign investments to pay for weapons and supplies. Assets that had been built up over generations were sold, often at unfavourable prices, to finance the immediate needs of warfare. What remained was a much smaller portfolio of foreign holdings and a substantial debt, particularly to the United States. The flow of investment income that had previously bolstered Britain's balance of payments was much reduced. The government's debt burden was another persistent problem. Servicing this debt, Paying interest to bondholders required substantial government revenue, which meant higher taxes than before the war. These higher taxes were politically controversial and economically constraining. The tax burden fell particularly on the middle and upper classes, the very people who had traditionally been the stock exchange's main clients as investors. When more of your income goes to taxes, you have less available to invest. This reduced the pool of capital-seeking investment opportunities, which in turn reduced the stock exchange's business. The pound sterling, which had been the world's dominant currency before the war, faced challenges. During the war, Britain had suspended the gold standard, the system whereby pounds could be freely converted to gold at a fixed rate. This suspension allowed the government to print more money to finance the war effort, but it also meant inflation and a weakening of the pound's value relative to other currencies, particularly the dollar. After the war, there was a strong desire among British policymakers to return to the gold standard, to restore the pound to its pre-war parity with gold. This was seen as essential to maintaining London's position as a financial centre and to preserving British prestige. In 1925, the government, with Winston Churchill as Chancellor of the Exchequer, decided to return to the gold standard at the pre-war parity of £4.86 per ounce of gold. This decision has been debated ever since. The argument in favour was that it would restore confidence in the pound, would signal that Britain remained committed to sound money and would honour its obligations. The argument against, made most forcefully by the economist John Maynard Keynes, was that the pre-war parity overvalued the pound, making British exports expensive and uncompetitive, and would require deflation, falling prices and wages to make the exchange rate sustainable. Keynes turned out to be right. The return to gold at the pre-war parity created persistent economic difficulties through the late 1920s. British exports struggled because they were expensive relative to foreign competitors. Industries that depended on exports, coal mining, textiles, shipbuilding, faced declining orders and had to cut wages and employment. This led to labour unrest, culminating in the general strike of 1926, when millions of workers walked out in support of coal miners resisting wage cuts. The strike lasted 9 days and failed to achieve its objectives, but it revealed the depth of social and economic tensions in post-war Britain. The stock exchange was affected by these economic difficulties, but also found opportunities. While traditional industries struggled, new industries were emerging: electrical engineering, automobile manufacturing, chemical production, consumer goods. These modern sectors were growing and needed capital. Companies in these industries issued shares, providing new securities for the stock exchange to trade. Investors who were astute enough to identify the industries of the future could profit even as traditional sectors declined. The investor base was also changing. More women were investing, not just wealthy widows, but also professional women who had jobs and incomes of their own. The war had accelerated women's entry into the workforce, and while many women had been pushed out of jobs when men returned from the front, some had remained. Women who earned money wanted to save and invest it, and they did so through stockbrokers, though they still couldn't become brokers themselves. The stock exchange remained an all-male institution in terms of membership, but its client base was slowly becoming more diverse. Investment trusts, which we discussed earlier, continued to proliferate in the 1920s. These pooled investment vehicles offered small investors access to diversified portfolios managed by professionals. The concept appealed to those who recognized they didn't have the expertise to select individual stocks, but wanted to participate in the market's potential gains. Investment trusts raised substantial capital and became significant players in the market, buying and selling large blocks of shares, influencing prices through their trading activity. The late 1920s also saw the beginning of what would become a major stock market boom, though this was centered more in New York than in London. American stocks were rising dramatically as investors became convinced that American business had entered a new era of permanent prosperity. Some British investors participated in this boom, buying American securities through brokers who had connections to New York. But London was somewhat removed from the most extreme speculation. The British market was more sedate, reflecting perhaps the lingering caution from the war, the awareness that things could go badly wrong, the memory of losses that was still relatively fresh. There were, nonetheless, speculative excesses in London as well. Certain favoured stocks, particularly in the new industries like electrical equipment and motors, saw their prices bid up to levels that were hard to justify based on earnings or dividends. Investors were buying based on expectations of future growth, on the belief that these companies would dominate the 20th century the way railways had dominated the 19th. Some of these expectations would prove correct, but in the short term, prices had gotten ahead of reality. The culture of the stock exchange in the 1920s retained much of its pre-war character, despite the changes in the broader world. It was still an exclusive club, still dominated by men from particular social backgrounds, still operating according to traditions and customs that seemed increasingly anachronistic. The jobber-broker distinction persisted. Transactions were still concluded with handshakes, still recorded on cards, still settled on account days every fortnight. The technology had improved marginally, telephones were more common, ticker tape more widely used, but the basic practices would have been recognisable to a Victorian broker. This conservatism had benefits and costs. The benefit was stability and continuity. Members knew the rules, trusted each other, operated efficiently within the established system. The cost was inflexibility and exclusion. The stock exchange was slow to adapt to changing circumstances, resistant to innovations that might disrupt established relationships, and closed to talented people who didn't fit the traditional mould. Jews faced barriers to membership, though not absolute exclusion. Catholics were underrepresented. People from working-class backgrounds, regardless of talent or knowledge, found it nearly impossible to enter. The stock exchange replicated and reinforced Britain's class structure. The international role of the London Stock Exchange in the 1920s was diminished but still significant. London remained a major financial centre, if no longer the unquestioned leader. British investors still bought foreign securities, though in smaller volumes than before the war. Empire securities, stocks and bonds from companies operating in India, Australia, South Africa, and other British territories, remained popular. These were seen as relatively safe because they operated under British law and British administration, with the implicit backing of British power. But the empire itself was changing. The war had accelerated movements for independence or greater autonomy in India, Ireland, Egypt, and elsewhere. The assumption that the empire would exist unchanged forever was increasingly questionable. This created uncertainty for investors. Would British investments in India remain secure if India gained independence? Would the legal protections and preferences that British companies enjoyed in imperial territories persist if those territories became self-governing? These questions didn't have clear answers, and uncertainty is uncomfortable for investors. The Irish situation was particularly acute. Ireland had been part of the United Kingdom, but after years of conflict and negotiation, the Irish Free State was established in 1922 as a self-governing dominion within the British Commonwealth, while Northern Ireland remained part of the United Kingdom. This partition was controversial and would have long-lasting consequences, but from the stock exchange's perspective, the immediate question was what it meant for investments. Were Irish securities now foreign or domestic? How should they be treated? These practical questions required answers, and the answers weren't always straightforward. Through the middle years of the 1920s, the stock exchange maintained its routines, adapted incrementally to changing conditions, and continued to serve as the marketplace where British savings met investment opportunities. The volumes traded were substantial, the business lucrative for successful brokers and jobbers, the institution stable. But there was a sense of operating in a diminished landscape, of managing decline more than participating in vibrant growth. Britain was no longer the world's workshop or the world's banker. It was still wealthy, still powerful, but relatively less so than before the war. The stock exchange reflected this diminishment. Then came October 1929 and the crash on Wall Street. The New York stock market, which had been rising dramatically through the late 20s, suddenly collapsed. On Black Tuesday, October 29th, 1929, panic selling drove prices down catastrophically. Fortunes were wiped out in hours. The crash marked the beginning of the Great Depression, the worst economic crisis of the 20th century, which would last through the 1930s and only truly end with the mobilization for the Second World War. The London Stock Exchange was affected by the Wall Street crash, but the impact was less severe than in New York. British stocks fell, but not as precipitously. There was concern and nervousness, but not the same degree of panic. This was partly because the British market hadn't risen as dramatically in the preceding years, so there was less froth to be blown off. It was also because British investors, scarred by the war and by the difficult economic conditions of the 20s, had been more cautious than their American counterparts. The memory of loss was fresher in Britain, the willingness to believe in unlimited prosperity more limited. Nonetheless, the depression that followed the crash did affect Britain severely. Unemployment rose dramatically. Export industries, already struggling, faced collapsing demand. The government attempted to maintain the gold standard, but found it increasingly difficult. The pound was under pressure as investors doubted Britain's ability to maintain the fixed parity between sterling and gold. In September 1931, Britain was forced to abandon the gold standard, allowing the pound to float and devalue against other currencies. This was seen at the time as a humiliating failure, an admission that Britain could no longer maintain the monetary system it had championed. The abandonment of gold actually helped the British economy by making exports cheaper and reducing the deflationary pressure that maintaining the gold standard had required. But it was psychologically damaging, another sign of Britain's diminished status, another break with the pre-war world order. The pound, which had been as good as gold, now fluctuated in value. The certainty and stability that the gold standard had represented were gone. The stock exchange struggled through the early 1930s along with the rest of the economy. Trading volumes fell as investors became more risk-averse, preferring to hold cash or very safe assets rather than stocks. Companies found it harder to raise capital because investors were unwilling to buy new share issues. The business of stockbroking became less profitable. Some firms failed or merged with stronger competitors. Clerks and junior employees were laid off as business contracted. The confident, prosperous world of the Edwardian stockbroker seemed impossibly distant. The government responded to the Depression with a mixture of orthodox economic policies and modest interventions. Taxes were raised, and spending was cut to try to balance the budget, which made the Depression worse by reducing demand. But there were also efforts to support struggling industries, to encourage rationalization and consolidation, to provide some relief to the unemployed. The interventions were limited by the prevailing economic orthodoxy, which held that government budgets should be balanced and that markets should generally be left to function without interference. The idea that government should actively manage the economy, should spend heavily during downturns to stimulate demand, wasn't yet widely accepted in Britain. The stock exchange itself undertook some modest reforms during this period. Listing requirements were tightened, requiring companies to provide more information and meet higher standards before their shares could be traded. This was meant to protect investors and to improve the quality of securities available on the market. The settlement process was made more efficient, reducing the time between when a transaction was agreed and when it was finalized. These were incremental improvements, not fundamental transformations, but they represented recognition that the market needed to adapt to maintain trust and functionality. One development that gained importance during the Depression was the preference share. These were shares that had priority over ordinary shares in receiving dividends and in claims on assets if a company failed. They offered less upside. If a company did extremely well, ordinary shareholders would benefit more, but they offered more security. In uncertain times, many investors preferred this security. Companies issued preference shares to appeal to this conservative preference, and the stock exchange facilitated the trading of these securities. The social impact of the Depression in Britain was severe, though perhaps not quite as catastrophic as in the United States or Germany. Unemployment peaked at around 3 million people, roughly 22% of the workforce. Entire communities dependent on declining industries, coal mining, shipbuilding, textiles, faced widespread joblessness and poverty. The images of the Depression in Britain are of dole queues, of unemployed men standing on street corners, of hunger marches protesting government policies. The stock exchange, in the wealthy city of London, seemed remote from this suffering, an enclave of relative prosperity surrounded by hardship. Critics on the political left argued that the stock exchange and the broader financial system bore responsibility for the Depression. They pointed to speculation and excessive risk-taking in the late 20s, to the priorities of financial capital over productive investment, to the system's tendency to concentrate wealth and power. Some called for nationalization of the banks and the stock exchange, for government control of investment to ensure it served social needs. These radical proposals never came close to implementation in Britain. The Labour Party, which represented working-class interests, briefly formed governments in the 20s and early 30s, but never had the power or the will to fundamentally transform the financial system. But the criticisms had an impact on the stock exchange's reputation and on the political environment in which it operated. There was less deference, less automatic respect for financial institutions and their leaders. The stock exchange had to justify itself, had to argue for its usefulness and legitimacy in ways it hadn't needed to before. This was uncomfortable for an institution that had long operated with minimal external scrutiny or accountability. By the mid-1930s, the worst of the Depression was easing in Britain, though unemployment remained high and recovery was uneven. Rearmament, as Britain began to prepare for the possibility of another war with Germany, provided an economic stimulus. Industries producing weapons, aircraft, and ships saw increasing orders. This created jobs and revived some depressed regions. It was a grim way to escape depression, preparing for war. But it worked where other policies had failed. The stock exchange benefited from this recovery. Trading volumes increased. Companies in industries related to rearmament issued shares and raised capital. Investors, seeing improved economic conditions and rising corporate profits, became more willing to put money into the market. The dark days of the early 30s began to recede, replaced by cautious optimism. But there was no return to the confidence of the pre-war years. Everyone knew another war was possible, perhaps even likely. The recovery was shadowed by fear of what was coming, by awareness that the peace since 1918 had been temporary, that the questions the Great War had supposedly settled were being reopened by the rise of fascism in Germany and Italy. As the 1930s drew toward their close, as Hitler's ambitions became clearer and appeasement failed to prevent aggression, the stock exchange faced the prospect of another war with profound unease. The First World War had been devastating. It had killed a generation, had shattered the international financial system, had diminished Britain's power and wealth. Another war threatened to complete the destruction, to finish what the First War had begun. The stock exchange and its members hoped desperately that war could be avoided, but they also began to prepare for the possibility that it couldn't, that once again the institution would have to suspend normal operations, that once again the nation's financial resources would have to be mobilized for survival. When war came in September 1939, the stock exchange was better prepared than it had been in 1914, though preparation could only do so much in the face of another global conflict. The memories of the previous war's disruption were still fresh enough that plans had been made, procedures established, contingencies considered. When Germany invaded Poland on September 1st and Britain declared war on September 3rd, the Stock Exchange Committee immediately implemented these plans. Trading was suspended just as it had been 25 years earlier, but this time the closure was briefer and more orderly. The exchange reopened on September the 7th, just 4 days after the declaration of war but under strict controls. Minimum prices were established for securities to prevent panic selling. Trading in many foreign securities was prohibited. The government, through the Treasury and the Bank of England, exercised oversight that was far more extensive than anything attempted in peacetime. The stock exchange would operate throughout the Second World War, but it would operate as part of a controlled wartime economy, not as an independent market following its own logic. The war itself was different from the previous conflict in crucial ways. The First World War had been primarily a war of attrition on the Western Front, of trenches and artillery, of slow-grinding combat. The Second World War was more mobile, more technological, more total in its mobilization of entire societies. It involved bombing of civilian populations, submarine warfare against merchant shipping, mechanized warfare across vast distances. Britain itself came under direct attack in ways it hadn't in the previous war. The Blitz, the sustained German bombing campaign against British cities in 1940 and 1941, brought the war home in visceral, terrifying ways. The Stock Exchange building in the City of London was damaged during the Blitz. On December 29, 1940, a night of particularly heavy bombing that became known as the Second Great Fire of London, incendiary bombs fell on the Exchange and on the surrounding area. The trading floor was damaged, offices were destroyed, records were lost. But the institution adapted. Trading moved to a basement that offered more protection from bombs. Members continued their work despite the danger, despite the fear, despite the surreal experience of conducting financial transactions while the city burned around them. The human cost of the war touched the stock exchange community deeply. As it had in the previous conflict, members served in the military and again many died. But this time the danger wasn't confined to those in uniform. The bombing killed civilians indiscriminately. Stockbrokers and their families, clerks and typists, the people who kept the financial system functioning, all faced the risk of sudden death from above. Air raid sirens would sound, and everyone would have to take shelter, waiting to see if their homes, their workplaces, their lives would still exist when the all-clear sounded. The government's financing needs were even more immense than in the First World War. The scale of modern industrial warfare, the costs of equipping vast armies and air forces and navies, the expense of supporting allies through programs like Lend-Lease with the United States required unprecedented levels of borrowing. National savings campaigns urged ordinary citizens to buy war bonds. Quote 4 proclaimed the posters. Quote 5, the stock exchange facilitated the distribution of these bonds, connecting the government's need for money with the public's savings. But the economic situation was different from the First World War in an important respect. Britain was more obviously dependent on American support. The United States, though initially neutral, provided crucial supplies under the Lend-Lease program, effectively lending Britain the resources to continue fighting. When America entered the war after Pearl Harbor in December 1941, the full weight of American industrial might was brought to bear against the Axis powers. But this support came with implications for the post-war world. Britain was accumulating debts to America, was becoming junior partner in what had been its own empire. The financial consequences would reshape Britain's global position. Trading on the stock exchange during the war years was subdued and heavily regulated. The volume was low compared to peacetime. There was little speculation, little of the dynamic buying and selling that characterizes a free market. Instead, the exchange functioned primarily as a mechanism for government borrowing and for the limited legitimate transactions that occurred in a wartime economy. Prices were controlled, activities were restricted, the normal functioning of markets was suspended in favor of centralized direction toward the war effort. Yet even in these constrained circumstances, the stock exchange performed useful functions. Companies that were essential to the war effort, manufacturers of aircraft, munitions, ships, military equipment of all kinds, needed capital to expand production. The government often provided this capital directly, but there were also opportunities for private investment. Shares in these companies could be traded, though the prices were affected by government contracts and regulations as much as by ordinary market forces. Investors who understood the war economy could still make money, though profiting from war felt morally complicated to some. Women's roles in the financial sector expanded significantly during the Second World War, building on the precedent of the First World War but going further. With so many men in military service, women were needed not just for clerical and administrative roles but for more substantive positions. Women worked as researchers, as analysts, as managers of investment portfolios. They demonstrated capabilities that had always existed but had been denied opportunity. The stock exchange itself remained closed to women as members, but the broader financial sector was becoming less exclusively male, at least temporarily. The experience of the Blitz and the broader hardships of war created a different social atmosphere than had existed in the First World War. There was less class deference, more sense of shared sacrifice and common purpose. The evacuation of children from cities to the countryside, the rationing that affected everyone regardless of wealth, the service of people from all social classes in the military and in civil defence, all created a sense that Britain was, in this crisis, more equal and united than in peacetime. This would have political consequences after the war, contributing to the Labour Party's landslide victory in 1945 and to the creation of the welfare state. The stock exchange, as an institution associated with wealth and privilege, was somewhat out of step with this egalitarian wartime spirit. But its members participated in the war effort in various ways, through military service, through civil defence work, through the essential function of keeping the financial system operating. The claim to legitimacy was less about status or tradition and more about practical utility. The stock exchange was useful, and in wartime usefulness was what mattered. As the war progressed and Allied victory became more likely, attention began to turn to what the post-war world would look like. The Beveridge Report, published in 1942, outlined plans for a comprehensive welfare state, including national health insurance, unemployment benefits, pensions, and family allowances. This vision of government responsibility for citizens' welfare from cradle to grave was popular and influential. It represented a decisive break from the limited government of the pre-war era, a recognition that the state had obligations to ensure basic security and opportunity for all. For the financial sector, including the stock exchange, this vision implied higher taxes to fund the welfare state, potentially more regulation, a different relationship between government and private enterprise. Some in the financial community were alarmed by these prospects, seeing them as steps towards socialism, as threats to property rights and free enterprise. Others recognized that some degree of reform was inevitable and necessary, that the pre-war system's failures had been too glaring to simply restore the old arrangements. The Bretton Woods Conference in July 1944 brought together representatives from Allied nations to design the post-war international financial system. The agreements reached at Bretton Woods created the International Monetary Fund and the World Bank, established a system of fixed but adjustable exchange rates, and made the dollar rather than the pound the world's primary reserve currency. This formalized the shift in financial power from London to New York, from Britain to America. The pound would still matter, London would still be an important financial centre, but the era of British financial dominance was definitively over. For the stock exchange, this shift had practical implications. International capital flows would increasingly be denominated in dollars, channeled through New York. American financial institutions would play larger roles in global finance. The stock exchange would have to adapt to operating in a world where it was no longer at the centre, where it had to cooperate with and sometimes defer to New York. This required psychological adjustment as much as practical adaptation, a coming to terms with diminished status. The war in Europe ended in May 1945 with Germany's surrender. The war against Japan continued until August, when atomic bombs dropped on Hiroshima and Nagasaki forced Japanese surrender. The Second World War was over, having cost even more lives than the First World War, having destroyed even more wealth, having transformed the world even more profoundly. Britain had been on the winning side, but victory had come at enormous cost. The country was exhausted, heavily indebted, physically damaged by bombing, economically depleted by 6 years of total war. The general election held in July 1945, even before the war with Japan ended, produced a shocking result. The Labour Party won a landslide victory, and Winston Churchill, the wartime leader who had guided Britain through its darkest hours, was voted out of office. The electorate wanted change, wanted the promises of the Beveridge Report implemented, wanted a society that would be fairer and more secure than the pre-war world had been. The new Labour government under Clement Attlee proceeded to implement sweeping reforms, nationalising major industries including coal, steel, railways and utilities, creating the National Health Service, expanding the welfare state. The stock exchange viewed these developments with considerable anxiety. Nationalisation meant that the shares of affected companies would be compulsorily purchased by the government, compensated but removed from private ownership and from the market. This reduced the range of securities available to trade. More broadly, the Labour government's rhetoric and policies seemed hostile to private enterprise and to financial markets. There were fears that the stock exchange itself might be nationalised, or so heavily regulated as to be unable to function. These fears proved somewhat exaggerated. The Labour government did implement extensive nationalisation and regulation, but it didn't attempt to eliminate the stock exchange or to completely control the capital markets. The government needed the financial system to function. Britain needed to rebuild, needed to finance recovery, needed to maintain its international financial position even if that position was diminished. The stock exchange could serve these needs, and the government recognised this even as it implemented socialist policies in other areas. The immediate post-war years were difficult for Britain and for the stock exchange. Rationing continued well into peacetime. Food rationing didn't fully end until 1954, 9 years after the war ended. The winter of 1946 to 1947 was particularly harsh, with fuel shortages causing factories to close and homes to go unheated. The economy struggled to transition from wartime production to peacetime needs. Export industries faced competition from countries whose industrial capacity hadn't been damaged by war, particularly the United States. The stock exchange operated in this environment of austerity and reconstruction. Trading volumes were modest. Many investors were cautious, scarred by 2 world wars and the Depression, uncertain about the future. The range of available investments was limited by nationalization. Returns on many securities were poor. It was not an exciting time to be a stockbroker. The business was steady but uninspiring, maintaining operations and serving clients but not experiencing the dynamism or growth that makes finance exhilarating. Yet there were also opportunities. Companies that were rebuilding or adapting to peacetime needs raised capital. New industries were emerging: electronics, aviation, pharmaceuticals, petrochemicals. These represented the future, and investors who identified them early could profit. The Marshall Plan, America's program for rebuilding Western Europe, brought capital into Britain and created opportunities. The empire, though beginning to contract as independence movements gained strength, still offered investment possibilities. The stock exchange gradually adapted to the post-war world. Technology was improving: better communications, better record-keeping, more efficient settlement processes. The physical building was repaired from war damage and upgraded. New members were admitted to replace those who had died or retired. The institution persisted, as it had through previous crises, finding ways to continue functioning, to remain relevant, to serve the needs of an economy that was different from the one it had originally been designed for. By the late 1940s, a certain stability had been achieved. Britain was poorer than before the war, relatively less powerful in the world, governed by a Labour government implementing socialist policies, but it was at peace and slowly recovering. The stock exchange was operating, facilitating capital formation, providing liquidity for investors, maintaining the mechanisms of finance. The glory days of Victorian and Edwardian dominance were long past, but the institution endured, adapted, served. It had survived 2 world wars and a depression. That survival was itself an achievement, evidence of resilience and utility. And as the 1950s approached, as the worst of the post-war austerity began to ease, there were signs that better times might be coming, that Britain and its financial institutions might find new roles and new prosperity in a world that had been fundamentally transformed by the catastrophes of the first half of the 20th century. The 1950s brought a gradual easing of the austerity that had characterized the immediate post-war years. Rationing ended piece by piece. The economy grew steadily, employment was high, wages rose, and living standards improved. Harold Macmillan, who became Prime Minister in 1957, famously told Britons they had, quote, six, and for many people this was true. The memories of war and depression began to fade, replaced by a sense of stability and modest prosperity. The stock exchange participated in and reflected this recovery, experiencing increased trading volumes and renewed confidence. One of the most significant developments of this period was the gradual dismantling of the British Empire and its transformation into the Commonwealth. India and Pakistan gained independence in 1947. Burma and Ceylon followed in 1948. Through the 1950s and 1960s, African colonies gained independence. Ghana in 1957, Nigeria in 1960, 57, Nigeria in 1960, Kenya in 1963, and many others. This decolonization had profound implications for British investors and for the stock exchange. For over a century, Empire securities had been a staple of British investment portfolios. Shares in companies operating in India, in African colonies, in Southeast Asia had been considered relatively safe because they operated under British law and protection. Independence changed this calculus. Would newly independent governments honour contracts and property rights established under colonial rule? Would British companies be allowed to continue operating, or would they face nationalisation? These uncertainties created risks for investors and complicated the role of the stock exchange in facilitating imperial investment. Some companies adapted successfully to decolonisation, transforming from colonial enterprises into multinational corporations operating in independent countries through negotiated agreements and local partnerships. Others were nationalised or driven out, with shareholders receiving compensation that was often less than the investment's perceived value. The stock exchange had to manage this transition, helping investors navigate the complex process of evaluating what their imperial holdings were actually worth in a post-imperial world. The decline of imperial investment was partly offset by the rise of European investment. Britain joined the European Free Trade Association in 1960, though it didn't join the European Economic Community until 1973, after 2 earlier applications were vetoed by France. But even before formal membership, British business was becoming more integrated with continental Europe. Companies invested across borders, creating opportunities for cross-listing securities and for British investors to buy European stocks. The stock exchange facilitated this European integration, though London remained somewhat ambivalent about its European connections, never fully comfortable with being just another European financial centre rather than the centre of a global empire. The 1960s brought cultural and social changes that affected even traditional institutions like the stock exchange. This was the decade of the Beatles and the Rolling Stones, of youth culture and social liberalisation, of challenges to established hierarchies and conventions. The stock exchange seemed anachronistic in this context, a stuffy, tradition-bound institution where men in formal dress conducted business according to rules that seemed designed to exclude and mystify rather than to include and clarify. Yet even the stock exchange couldn't entirely resist the spirit of the times. Dress codes relaxed slightly. The language used became somewhat less formal. More importantly, pressure grew to modernise practices and to open membership more widely. The absolute exclusion of women from membership became harder to justify in an era when women were entering professions throughout society. The barriers against Jews and Catholics, while never formalised, had been real, and these too began to weaken as social attitudes changed. Technology was also beginning to transform how the stock exchange operated. Computers were introduced for record keeping and for calculating settlements. This was still early computing technology, room-size mainframe computers that required specialised operators, but it represented a significant advance over purely manual record keeping. The ticker-tape machines that had been cutting-edge in the late 19th century were supplemented and eventually replaced by electronic displays showing real-time prices. Communication improved with better telephone systems, and eventually with electronic data transmission. These technological changes enabled the stock exchange to handle larger volumes of trading more efficiently. As the British economy grew through the 1960s, as more companies went public and more individuals invested, the volume of transactions increased substantially. The old manual systems would have been overwhelmed. Technology allowed the stock exchange to scale up, to manage complexity that would have been impossible with 19th century methods. The 1960s also saw the emergence of institutional investors as dominant players in the market. Pension funds, insurance companies, and investment trusts managed vast pools of capital on behalf of their beneficiaries. These institutions employed professional fund managers who bought and sold securities in large blocks. Their trading activity dwarfed that of individual investors. A single transaction by a pension fund might involve millions of pounds worth of shares, whereas an individual investor might buy a few £100s worth. This shift toward institutional dominance changed the character of the market. Institutional investors were more sophisticated than typical individual investors, had more resources for research and analysis, and had more bargaining power when negotiating transactions. They demanded better service from brokers and jobbers, lower fees, more detailed information. They also had longer time horizons. A pension fund investing to meet obligations decades in the future could weather short-term market fluctuations in ways individual investors often couldn't. The jobbers on the stock exchange floor had to adapt to this institutional dominance. Maintaining inventory in shares, buying and selling from their own accounts, became riskier when institutions could place huge orders that could quickly exhaust a jobber's capital. Some jobbers specialised in institutional trades, building the capital and the risk management capabilities needed to handle large transactions. Others focused on smaller trades, serving individual investors through brokers. The market was stratifying, becoming more complex and differentiated. Through the 1960s and into the 1970s, Britain's economic performance was mixed. There was growth, but it was slower than in competing nations like Germany and Japan. Inflation began to accelerate, driven partly by rising oil prices and partly by domestic wage pressures. Labour disputes became more frequent and more disruptive. The pound, which had been devalued in 1949, was devalued again in 1967, a humiliating admission that Britain's economy was weaker than the official exchange rate implied. The 1970s would bring stagflation, the combination of stagnant growth and high inflation, which challenged conventional economic thinking and created difficult conditions for everyone, including the stock exchange. The stock exchange itself came under scrutiny during this period. A series of scandals and failures raised questions about whether the self-regulatory model was adequate. Some brokers and jobbers had engaged in questionable practices, front-running client orders, manipulating prices, providing misleading information. Some firms had failed, leaving clients with losses. The argument that the stock exchange could police itself, that its members' commitment to honour and tradition would prevent serious abuses, seemed less convincing in light of these problems. There were calls for external regulation, for government oversight to protect investors and to ensure market integrity. The stock exchange resisted, arguing that outsiders couldn't understand the complexities of the market, that regulation would be heavy-handed and would stifle innovation, that self-regulation worked if it was properly enforced. But the pressure for reform was growing, driven by media coverage of scandals, by investor complaints, and by politicians who saw political advantage in promising to clean up the city. In 1973, the oil crisis struck when Arab oil producers imposed an embargo and dramatically raised prices. This had global economic effects, but it hit Britain particularly hard. Inflation soared, reaching over 20% by 1975. Economic growth stalled. Unemployment rose. The stock market fell sharply as investors fled to safer assets. The index of leading shares, the Financial Times Stock Exchange 100 share index that had been created in 1984, lost nearly half its value in the bear market of 1973 to 1974. This was the worst stock market decline since the 1930s, and it traumatized investors and shook confidence in equities as investments. The Labour government elected in 1974 implemented policies that the financial sector viewed with alarm. There was talk of more nationalisation, of wealth taxes, of controls on capital movements. The top marginal tax rate on investment income reached 98%, essentially confiscatory. This was meant to redistribute wealth and to fund expanded social programmes, but it also drove capital out of Britain and discouraged investment. The stock exchange operated in an environment that felt hostile, where the government seemed to view private capital and financial markets as problems to be controlled rather than as useful parts of the economic system. Yet even in this difficult environment, the stock exchange continued to function. Companies still needed to raise capital. Investors still wanted to buy and sell securities. The mechanisms persisted even when conditions were unfavourable. This resilience was partly structural. The market served functions that couldn't easily be performed other ways, and partly cultural. The members of the stock exchange believed in what they were doing, believed that markets were important and useful, and were willing to continue even when the broader political and economic climate was challenging. The late 1970s brought some easing of the crisis. Inflation, while still high, began to fall. Economic growth resumed, though modestly. The pound stabilised after floating freely since 1972, when the decision was made to abandon fixed exchange rates entirely. Britain joined the European monetary system, though not its core exchange rate mechanism, maintaining some monetary independence while cooperating with European partners. The stock exchange benefited from this stabilisation, with trading volumes recovering and prices beginning to rise again after the catastrophic losses of the mid-70s. The election of Margaret Thatcher's Conservative government in 1979 marked a decisive shift in British economic policy. Thatcher was committed to free market principles, to reducing government intervention in the economy, to privatising nationalised industries, to lowering taxes and reducing regulation. For the stock exchange and the broader financial sector, this represented a dramatic change from the Labour government's approach. The new government viewed financial markets as useful, as engines of prosperity rather than as problems to be controlled. Thatcher's government moved quickly to implement its agenda. Exchange controls, which had limited how much money British residents could take out of the country, were abolished in 1979. This allowed British investors to buy foreign assets more freely and allowed foreign capital to flow into Britain more easily. The abolition was controversial. Critics argued it would lead to capital flight. that British money would flow abroad rather than investing domestically. But Thatcher believed that free capital movements were essential to a modern economy, that restrictions distorted markets and reduced efficiency. The privatisation programme began in the early 1980s and accelerated as the decade progressed. Nationalised industries, telecommunications, gas, electricity, water, steel, aerospace and many others, were sold to private investors through share offerings. These privatisations were enormously significant for the stock exchange. Millions of shares in newly privatised companies were offered to the public, creating a massive expansion in the number of individual shareholders and in the volume of securities available to trade. The government promoted these offerings with advertising campaigns encouraging ordinary people to buy shares, to become capitalists, to participate in ownership. The British Telecom privatisation in 1984 was particularly significant. This was the largest share offering in British history to that point, with the government selling over 50% of British Telecom to private investors. The offer was heavily oversubscribed. Far more people wanted to buy shares than there were shares available. This demonstrated both the pent-up demand for investment opportunities and the success of the government's campaign to promote popular capitalism. Millions of people who had never owned shares before became shareholders through British Telecom and subsequent privatisations. For the stock exchange, privatisation was transformative. The volume of trading increased dramatically. The number of listed companies expanded. The value of the market capitalised. The total worth of all shares traded on the exchange grew substantially. The institution that had seemed somewhat marginal during the difficult 70s was suddenly central to a major government policy initiative and to a broader cultural shift toward market-oriented thinking. But privatisation also highlighted tensions within the stock exchange's traditional structure. The flood of small investors buying privatisation shares needed different services than traditional institutional investors. They needed advice, needed user-friendly information, needed accessible ways to buy and sell shares. The stock exchange's traditional broker-jobber system, designed for professional investors conducting large transactions, wasn't ideally suited to serving millions of small shareholders. The need to adapt to this new reality would contribute to the pressures for reform that culminated in the Big Bang of 1986. Technology continued to advance through the early 1980s. Electronic trading systems were being developed that could match buyers and sellers automatically, without requiring brokers and jobbers to meet face-to-face on a physical trading floor. These systems promised greater efficiency, faster execution, lower costs. But they also threatened to make the traditional stock exchange structure obsolete. If trading could be done electronically from offices anywhere, why did you need a physical exchange? Why did you need the distinction between brokers and jobbers? Why did you need fixed commissions and established practices that dated to the 19th century? The stock exchange faced a choice: reform itself voluntarily, modernizing its structure and practices to remain competitive, or resist change and risk becoming irrelevant as business moved to other trading venues or other financial centres. The government, particularly the Department of Trade and Industry, was pressing for reform. There were threats of legislation to force changes if the stock exchange didn't act. In this context, the Stock Exchange's Governing Council made the decision to implement comprehensive reforms, to abandon practices that had persisted for generations, to transform the institution fundamentally. This transformation would be known as the Big Bang, and it would change the stock exchange more in a single day than it had changed in the previous century. If you're finding these contemplative explorations of Westerosi history and politics a peaceful way to end your day, a like and subscribe really helps others discover these gentle journeys through the past. And to those already subscribed, thank you for being part of this community of those who find comfort in slowly unfolding stories of power and patience, of roses growing strong through centuries of careful cultivation. The Big Bang happened on October 27, 1986, and its name was apt because it represented an explosive transformation of the London Stock Exchange. In a single day, multiple fundamental changes were implemented simultaneously. Fixed commissions were abolished, allowing brokers to negotiate fees with clients rather than charging standardized rates. The distinction between brokers and jobbers was eliminated, allowing firms to act as both agents and principals, what was called dual capacity. Foreign firms were allowed to own member firms, ending the restriction to British ownership, and electronic trading was introduced, replacing the face-to-face transactions on the physical trading floor. These changes had been planned for months, negotiated between the stock exchange and the government, prepared for with new computer systems and new organisational structures. But implementing them all at once was still shocking, still represented a decisive break with tradition. The stock exchange that emerged from the Big Bang was fundamentally different from the one that had existed the day before. Practices that had persisted for 2 centuries ended overnight. The abolition of fixed commissions was meant to increase competition and reduce costs for investors. Under the old system, all brokers charged the same commission rates, which were set by the stock exchange. This meant that brokers competed on service and relationships rather than on price. The new system allowed negotiation, which meant that large institutional investors could demand discounts in exchange for their substantial business. This was good for those large investors, who saw their transaction costs fall, but it was challenging for brokers who had built their businesses on commission income and now faced pressure to reduce fees. The end of single capacity, the separation between brokers and jobbers, was perhaps the most dramatic change. For generations, this separation had been seen as essential to preventing conflicts of interest. A broker acting as an agent for clients shouldn't also be trading for their own account because the interests could conflict. But the separation also created inefficiencies. A broker placing a large order for a client had to find a jobber willing to take the other side, and the jobber's profit from the spread between bid and ask prices added to the client's costs. Allowing firms to act in dual capacity meant they could match buyers and sellers internally, potentially reducing costs and increasing efficiency. But dual capacity also created the conflict of interest problems that single capacity had been designed to prevent. A firm trading for its own account while also handling client orders had incentives to favour its own interests. If a firm knew a large client order was coming, it could trade ahead of that order for its own benefit, a practice called front-running. The Big Bang didn't solve this problem, it just changed its nature. Instead of structural separation preventing conflicts, there would need to be rules and oversight to manage them. The opening to foreign ownership was motivated by the recognition that British firms lack the capital to compete in an increasingly global market. American, Japanese, and European financial institutions had substantial capital and sophisticated capabilities. Allowing them to buy British firms or to establish their own operations in London would bring in resources, expertise, and connections. It would also increase competition, which would benefit clients even as it challenged established British firms. What followed was a wave of acquisitions. American investment banks like Goldman Sachs, Morgan Stanley, and Salomon Brothers bought British stockbroking and jobbing firms or established major London operations. Japanese banks did the same. European institutions entered the market. Many old-line British firms, some with histories going back a century or more, were absorbed into foreign-owned conglomerates. The partners who sold their firms became wealthy. The capital injection from foreign buyers created instant fortunes, but the independence and distinctive character of these firms were lost. Electronic trading represented the most visible change to anyone observing the stock exchange. Before the Big Bang, trading occurred on a physical floor where hundreds of brokers and jobbers met face-to-face, shouted orders, and sealed deals with handshakes. After the Big Bang, trading increasingly occurred through computers. Brokers and traders sat at desks in their offices, watching screens showing prices and entering orders electronically. The computer systems matched buyers with sellers, executed transactions, and recorded the details automatically. This electronic trading was more efficient in many ways. It was faster. Transactions that might have taken minutes to execute on the floor happened in seconds electronically. It was more transparent. Prices were displayed publicly rather than being quoted individually to each buyer. It was accessible. Traders didn't need to be physically present on the exchange floor. They could trade from anywhere with a computer connection. These advantages meant that electronic trading quickly came to dominate, and the old trading floor became increasingly irrelevant. The death of the trading floor represented the end of a particular culture and way of doing business. The floor had been a distinctive space with its own customs, its own language, its own social hierarchies. Relationships mattered enormously. Reputation and trust were built through years of face-to-face interaction. The transition to electronic trading meant these relationships became less central. What mattered now was having the best technology, the fastest systems, the most sophisticated algorithms. The human element didn't disappear, but it became less visible, more mediated through machines. For the people who had worked on the trading floor, the Big Bang was often experienced as a loss. Many of the old brokers and jobbers retired or were pushed out, unable or unwilling to adapt to the new electronic environment. The skills that had made them successful, the ability to read body language, to negotiate face-to-face, to maintain complex webs of personal relationships, were less valuable in a world of screen-based trading. Younger people, comfortable with computers, often replaced them. The stock exchange's workforce became younger, more diverse in some ways, though it remained predominantly male. Women began to enter the industry in larger numbers after the Big Bang, though true equality remained elusive. The formal barriers had fallen. Women could now be members of the stock exchange, could work as brokers and traders. But informal barriers persisted. The culture remained masculine, sometimes aggressively so. Women who succeeded often did so by adapting to this culture rather than changing it. Still, the change from absolute exclusion to limited inclusion was significant, and over subsequent decades, women's presence in finance would continue to grow. The Big Bang also coincided with a broader transformation of the City of London. The square mile where the stock exchange and most of Britain's financial institutions were concentrated. New office towers were built to house the expanded financial sector. Old buildings were renovated and repurposed. The physical landscape changed as dramatically as the institutional landscape. The city that had been dominated by solid Victorian and Edwardian buildings, by gentlemen's clubs and traditional chop houses, was becoming more modern, more international, more oriented to global finance than to British tradition. The immediate aftermath of the Big Bang was exhilarating but also chaotic. Trading volumes surged. The number of firms operating in London increased dramatically. Salaries and bonuses soared as firms competed for talented traders and analysts. The financial sector, which had been somewhat staid and conservative, became dynamic and aggressive. This was the beginning of what would be called the quote, Seven era, exemplified in popular culture by the film quote, Eight and its character Gordon Gekko. The restraints of tradition and social convention seemed to fall away, replaced by a more raw capitalism focused on profit maximization. But the Big Bang also created instabilities that would become apparent in the years following. The increased leverage, the use of borrowed money to amplify trading positions, created greater potential for both profits and losses. The complexity of the new electronic systems meant that problems could cascade quickly, that errors could have large consequences. The global interconnection of financial markets meant that events anywhere could affect London, and vice versa. These vulnerabilities were dramatically exposed in October 1987, just over a year after the Big Bang. On October 19th, 1987, a day that became known as Black Monday, stock markets around the world crashed. The Dow Jones Industrial Average in New York fell by 22% in a single day, the largest one-day percentage decline in its history. The London market fell nearly 11%. Other markets worldwide experienced similar or worse declines. The total value of shares on global markets fell by trillions of dollars. The causes of the 1987 crash were complex and are still debated. Computerized trading programs that automatically sold when prices fell below certain levels may have accelerated the decline. Concerns about rising interest rates and overvaluation contributed. But whatever the specific triggers, the crash demonstrated the fragility of the post-Big Bang financial system. The very features that made markets more efficient, speed, interconnection, computerization, also made them more vulnerable to sudden shocks. The London Stock Exchange managed the crisis reasonably well. Unlike in 1914 or 1939, the exchange didn't close. Trading continued, albeit at depressed prices and high volumes. The electronic systems handled the surge in transactions, though there were glitches and delays. Importantly, the settlement system, the mechanism for actually transferring shares and money after trades were agreed, functioned. Firms honoured their obligations even when those obligations had become expensive due to falling prices. The market infrastructure held. In the aftermath of the crash, there was soul-searching about whether the Big Bang reforms had gone too far, whether the push for efficiency and competition had created dangerous instabilities. But the consensus was that the reforms were necessary, and that the problems revealed by the crash needed to be addressed through better risk management and oversight rather than by rolling back the changes. Markets recovered relatively quickly from the 1987 crash. Within 2 years, prices had returned to their pre-crash levels. The episode was frightening but not catastrophic in the way the 1920s crash had been. Through the late 1980s and into the 1990s, the London Stock Exchange continued to evolve in response to technology and competition. Automated trading systems became more sophisticated. Information flowed faster as real-time data services improved. The exchange merged with other trading venues and reformed its governance structure, demutualizing in 2000, converting from a member-owned organization to a publicly traded company. This was a profound change, ending the model of mutual ownership that had existed since the coffeehouse days and replacing it with corporate ownership accountable to shareholders. The demutualization reflected the reality that the stock exchange was now a business competing with other exchanges and trading platforms globally. To compete effectively, it needed to raise capital, to invest in technology, to operate with the flexibility and efficiency of a corporation rather than a membership club. The members who owned the exchange received shares in the new company, and many sold those shares immediately, cashing out of the institution they or their predecessors had built over generations. London's position as a global financial centre was strengthened during this period, somewhat paradoxically given Britain's declining relative economic power. The Big Bang reforms had made London attractive to international financial institutions. The regulatory environment was relatively light compared to other major centres. The time zone was convenient, allowing London to bridge trading between Asian and American markets. English as the common language of international finance was an advantage. The concentration of expertise, the depth of markets, the availability of supporting services, all made London a compelling place to conduct financial business. The turn of the millennium brought new technological challenges and opportunities. The internet was transforming commerce and communication. Online trading platforms allowed individual investors to buy and sell stocks without going through traditional brokers. Information that had previously been available only to professionals became freely accessible to anyone with an internet connection. The barriers to entry for retail investors fell dramatically. This democratization of investing was celebrated by some as empowering and by others as dangerous, giving unsophisticated investors access to complex markets where they could lose money quickly. The stock exchange adapted to this new reality by developing its own electronic platforms and by establishing rules for online trading. But it also faced competition from purely electronic trading venues that had no physical location, no traditional structure, no historical legacy weighing them down. These new venues could offer lower costs and faster execution. The question of whether traditional exchanges would remain relevant or would be displaced by newer, more nimble competitors remained open. Through all these changes, the Big Bang, the crash of '87, demutualization, the internet revolution, the fundamental functions of the stock exchange persisted. It remained a marketplace where savers could provide capital to businesses and where investors could buy and sell ownership stakes in companies. The mechanisms changed, the participants changed, the technology changed, but the basic purpose endured. Companies still needed to raise capital for expansion and investment. Investors still wanted opportunities to profit from economic growth. The stock exchange connected these needs, facilitating transactions that would have been much more difficult without an organised market. As we move toward our own time, as the London Stock Exchange becomes less a historical subject and more a contemporary institution, the long arc of its development becomes visible. From coffee houses to computers, from handshakes to algorithms, from British exclusivity to global integration, the transformation has been profound. Yet there's also continuity. The same basic activities, buying and selling ownership stakes in enterprises, occur now as occurred 300 years ago. The scale is vastly larger, the speed incomparably faster, the reach global rather than local, but the essence remains. The stock exchange persists because it serves functions that economies need, because it creates value by matching those who have capital with those who need it, because it provides liquidity and price discovery that make markets work. These functions survived the South Sea Bubble, the Napoleonic Wars, railway mania, 2 world wars, the Depression, and countless other crises. They survived because they're genuinely useful, because economies work better with functioning capital markets than without them, because for all their flaws and periodic failures, markets help allocate resources and enable economic activity that improves human welfare. This usefulness is the stock exchange's ultimate justification, the reason it has endured for over 3 centuries, the reason it will likely continue in some form into the future, even as it continues to evolve in ways we can't yet imagine. And so, we've travelled together through 3 centuries, from smoke-filled coffee houses where merchants gathered over coffee to gleaming towers where algorithms execute trades in microseconds. We've witnessed the birth of modern finance from informal conversations, watched it survive bubbles and crashes and wars, seen it transform again and again while its essential purpose persisted, connecting those who have capital with those who need it, enabling ventures that individuals alone could never undertake. This story, like all economic history, is ultimately about human ambition and adaptation, about our capacity to create systems that serve us, to learn from catastrophic failures, to rebuild after everything seems broken. The merchants at Jonathan's coffee house couldn't have imagined the London Stock Exchange of today, just as we can't fully imagine what it will become. But they would recognise the fundamental activity, people taking risks, making investments, hoping for returns, building fortunes quietly over time. As you drift towards sleep now, let this long story settle gently in your mind. You're part of this continuing narrative, connected to centuries of human enterprise and innovation, to the slow, patient building of systems that enable prosperity. The stock exchange persists as you persist, adapting to whatever comes while maintaining essential purpose. Let your breathing slow. Let the weight of history become comforting rather than heavy. All those centuries, all those quiet fortunes, all that patient capital flowing toward the future. You can rest now. The story continues whether you're listening or dreaming. Let yourself drift. Let go. Sleep well.